What do you, so in the event of a correction, or let's say getting into a bear market territory, so 20% down off of highs, what do you suggest for, not to give investment advice, just to be clear, but like in general, how should people frame this? What should they be doing? What should they be thinking about?
They should remain consistent to their original investment strategy. Don't switch lanes just because the getting looks poor. Stay in your lane. That's what I'm basically saying. Stay in your lane. Be consistent. If you were making contributions before the downturn, continue to make said contributions.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my colleague, Nathaniel Leach. We do not have Dan today. Dan is feeling a little under the weather, so we decided to get him off the hook today. So it'll just be the two of us. And before we start getting into our topic today, which are...
If I may, I'm sorry, you said the phrase, just the two of us. I have to do it. Just the two of us. We can make it if we try. Just the two of us. You and I. Bring.
Thank you, Nathaniel. That is actually a great lead into, if you like our content, aka Nathaniel's voice, please share, subscribe, and like our content. We would really appreciate it. It would help us out. It gets the word out. We're really just trying to educate people, plus make them happy with Nathaniel's voice. So again, please share, like, and subscribe. That would be wonderful. So, Thanny, since it's the two of us, today we're going to talk about the market. And we're going to talk about what's going on in the market. I know this is Nathaniel's favorite topic because it's complicated and nobody really knows. And that's probably it. But we're at least going to get some thoughts out of Nathaniel today, have a little bit of a conversation, discuss what's going on. So, Nathaniel, could you just kind of set the stage for the audience and our listeners, viewers, about what's transpired at the beginning of 2022 with the current market? And you can describe it as define the market as S&P 500, the Dow Jones, NASDAQ. You pick, you choose. Just talk a little bit about and give an overview of what's going on.
Sure, Tim. So it actually didn't start in 2022. It actually started later in 2021, where some more growthy stocks who had been in what I would call bubble or extreme overvaluation territory started to crest the wave, and there was little pops everywhere you go.
Nathaniel, could you define like a growthy stock? Like what does a growthy stock mean?
Sorry, good point. So a growthy stock is okay, we all know that there's things called value stocks and growth stocks. We tend not to focus on either one in particular. We just focus on investing in companies where we feel like they have solid business fundamentals and are selling for either a cheap or fair price. They're very few and far in between. That said, there are a number of what I would call growthy or speculatively priced or overpriced securities out there that, as I was saying, late in 2021 started to crest the wave. It started to go down. So things like cryptocurrency, SPACs. Remember how SPACs were the craze at the beginning of 20 and 21? You all should listen to our podcast about that whole craze and GameStop back then. I think we said some pretty prescient things, as a matter of fact. Other things such as meme stocks. So like GameStop, for example. There's this whole thing about GameStop going from $3 or $4 a share to over $300 a share at one point. It's now trading below 100 just recently. those are the types of things where we started to see that bubble pop, because in a lot of investors' minds, those were not, there was no substantial, the price was greater than the value, if there is even any value to speak of, because some of these things, there's no value in them. I mean, one could argue that some of the SPACs that we saw issued, a number of them put forth growth forecasts that there was no way that they could achieve. And yet, because of the SPAC, how a SPAC can get away versus, say, an IPO can get away with such speculative forecasts, they were able to legally say that we think that we can do this in the next 3-5 years, whatever. And a lot of them didn't do it. So their prices were very speculative for a period of time, but then as reality set in and investors saw the writing on the wall, they began to redeem their shares for the trust value that they could receive for their shares. And those prices, those market prices, began to pop. And that's what we were seeing just in the SPAC area. So that's just one piece. So in 2022, as Powell has been confirmed for a second term, he and the Fed immediately stated that there were interest rate hikes on the horizon, and that they were going to continue to pull back on the bond buying program. The market began to seriously start to, market being the S&P 500, Dow Jones Industrials, NASDAQ, whatever you want to call it, began to re-rate in their market prices to account for these statements and actions being made by the Fed. And that's just here in the US. There's other countries around the world that have been making their own moves in their central banks, some consistent with ours, that is raising rates or dialing back other such bond buying programs that they may have. Or in some cases, China just recently announced that they were actually cutting their interest rates. That makes sense, perhaps, for their economy. It certainly probably doesn't make sense for ours.
I think for our listeners to kind of clarify a little bit, when you say re-rate, when investors re-rate their investments, what exactly do you mean by that? For our listeners, our Fed chair has come out and has said, hey, we're going to increase interest rates potentially. We're supposed to find out here in the next couple of days if what the Fed's action plan will be. But they have indicated that rising. And so then you mentioned, hey, investors are now re-rating their investments. Why are interest rates important to that in a simple fashion? Could you explain that to our audience, what that means?
So interest rates are like gravity. They pull prices back down to earth. It's pretty much how it works. Because as the interest rates rise, so as the interest rates filter through the economy, and interest rates begin to rise all over the place, you would see it as lending rates will increase. And therefore, the savings rate, the rate that you're able to receive on your savings, will also increase, because the bank has to make their spread. And then you'll also see, for example, you're actually seeing this right now in lending rates in mortgage interest rates, as a matter of fact. Those have gone up a little bit recently in the past couple months. Where you'll also see this is because the interest rates are then increasing in such risk-free assets, such as treasuries, U.S. government-issued bonds and notes. As these interest rates rise, they then start to look more appealing than other types of assets. Other types of assets can consist of corporate bonds, high yield bonds, stocks. So those stocks that had been growing quite nicely in a low interest rate environment, depending on the company and what the company does, their stock prices are some of them are now coming back down to earth. They're re-rating because their prices and their stocks as when you buy them are looking less appetizing in comparison, or things are being projected forward as interest rates have not risen that much because the Fed has not yet raised interest rates. But the market is forecasting ahead and saying, oh, we don't like the sound of this. Interest rates are probably going to go up. Therefore, these high growth, high priced, overvalued stocks are now coming back down to earth a little bit and may continue to do so, or they may stay where they're at. What could happen, as has happened in the past, where the Fed has originally said, oh, we're going to raise rates, or we're going to stop repurchasing bonds, which keeps interest rates artificially low. They have said, oh, we're going to stop doing that. And then they stop doing that, or they're about to stop doing that. And then the markets go crazy. And then they step back in and say, oh, haha, just kidding. We're actually not going to do that. And then the markets go right back up. So that could happen. It may not happen, though. When you look at the facts, the Powell, again, as we stated, has been elected for a second term. So he's locked in. He's not going anywhere. So he now has essentially he now has the political capital, if you will, to do what changes that he and the Fed believe need to be implemented. So there isn't a lot standing in his way to do so, apart from whatever his fears might be of how the market might react to his and the Fed's actions. We'll see how that all shakes out.
Okay. So if I were to explain it in very simple terms with this re-rating, it'd be kind of like the analogy, 2 birds in the bush or 1 in the hand. If I'm going to take my kind of guarantee, which we know there's no such thing as guarantee. So I'm going to take the bird in the hand instead of trying to speculate on the 2 birds in the bush, trying to shoot those 2 birds, right? So I can either double up or I can just take what I have. So as interest rates move up, like with these treasuries, so the United States government is backing these securities. It's like, hey, if interest rates get up to 6-7%, and I can make 6 to 7% kind of guaranteed, why would I then have to speculate it into the market, aka trying to shoot those birds down, when I can just kind of have what I want, right? That's kind of the overall like simplification of re-rating from a risk perspective of what I would put my assets into or not.
I'd say that's correct. Yes. You mentioned another interesting piece, though, in that, so like the 6 to 7% interest rate concept. Let's say it does get up to that. Well, one other factor that we haven't yet mentioned is inflation. So we're in the camp of it could go either way. I mean, one can make the argument that there was inflation due to federal stimulus as well as supply chain imbalances. But then another argument can be made that COVID happened and a lot of demand went down for a period of time, and now it's overreacting, it's overcorrecting to account for that lost demand for that period of time. So when inflation goes up, that's generally when the Fed steps in to raise interest rates to counter that inflation. So even if you have, so that's an interesting piece, because even as interest rates rise, if inflation stays high as well, then that 6 to 7% interest rate, as an example, if inflation is 5 or 6%, then your return is 1 or 2%. So then you compare that to a stock that's maybe you think is going to earn 12% or 14%, then that starts to still look pretty attractive. So if there still remains companies out there that show these high growth rates over time, of which there are a good few, then it still would make sense to own those stocks. But I still think that as interest rates rise, that there are going to be a good portion of stock prices that are coming back down to account for that interest rate increase. But it remains to be seen what happens with interest rates. Again, the Fed's raising rates does not necessarily mean that interest rates will go up. They are simply one of many levers, a big lever, don't get me wrong, a huge lever, but they're one of many that have that will affect interest rates. There's, as we've said many times before, there are millions of decisions that go into what comprises of the markets today. Millions of individuals, billions of individuals a day making tens of hundreds of decisions that can affect what happens in the markets. It's as simple as whether I decide to go to the gas station to purchase that slushy. It's as simple as that.
Yeah. So, which brings me kind of to my next point, and we saw a little bit of that actually today. So to postmark this is January 24th of 2022. We saw the markets dip pretty significantly for a day, but then actually rebounded back up and ended up positive for the day. It was quite a large swing. I think there was some headlines that it might have been the largest day swing. I think in the NASDAQ, I believe. I don't quote me on that, not 100% sure. But the reason why I'm bringing that up is it seems that we have seen larger swings, but like wild ups and downs, like wild reactions, which I am curious, Nathaniel, on your thoughts. Do you feel part of what we may see in the market moving forward is more severe drops, but also more severe upswings? And do you feel like that's due to technology and potentially algorithmic trading, where we're hitting certain price points, we're hitting certain resistant bands or whatever's being built into these algorithms, and it's automatically selling or automatically buying, which could create a little bit more of that volatility within the market than maybe we saw in 1990 to 2000. Do you have any thoughts on that in general?
I do think that there's going to be a lot of volatility going forward. I mean, we've already seen it throughout COVID and as the pandemic has become endemic.
Retail investors too built into that, just having more access to easy trading mechanisms.
That's the meme stock revolution and SPACs and cryptocurrencies. That's got that written all over it, mixed with the stimulus funding. It's Christmas every day. People staying at home, they don't have much time on their hands. Some of them don't. Some of them don't have kids, so they got a bunch of time on their hands. With algorithms, yes, I do think they are a factor, but I would argue that index funds are more of a factor because for a number of reasons. In that, if you ever noticed that the beginnings and the endings of every day's markets are the most volatile times of the day. And that's in part due to algorithms doing trading, but it's also in part due to index funds who are basically sorting out their orders for the day. They sort out in the beginning of the day the orders that they received the night prior, or are being shot into the market just at the beginning of the market. And then at the end of the day, they're then re-rating to account for all the orders that have come in and gone out and so on and so forth. And that's one piece. The other piece is that, again, we've talked about this ad nauseum, is that index funds have become more prolific within employer retirement plans. So before the index funds really became a craze, really in the last 10 to 15 years, within employer-sponsored retirement plans, they principally comprised of actively managed mutual funds, which typically had higher expense ratios and purported to be market beating over the long term, or in the short term in some cases. But as index funds became more popular, employer-sponsored retirement plans became more conscious of this and decided to put them within their plans. And as index funds have done better and better and better, it has become a feedback loop whereby people are seeing, oh, these are great returns in the indices. I'm going to get in on that. people just start shoveling their employer retirement into those plans, into those index funds, which is great for them because it's index and fund investing is a solid investment strategy. Where a lot of people get in trouble is when they start to market time and they start to see the markets fall and they think, oh, I got to get my money out. So what's been happening in the index fund arena, ETFs, mutual funds of indices, is that there's been this feedback loop where as more money is put into them, and more people start to see how well they've done, then the indices continue to rise. And what happens if the reverse occurs? What happens if people get scared and start to pull their money out? We saw this happen in the great financial crisis. I love to tell this story. I don't know if this guy is still in the same boat, but I love to tell the story about, I worked across the way from a gentleman, and he told me that, and this was in 2013, 2014, I think he told me this. He told me that he had taken his money out right at the bottom of the great financial crisis, and he hadn't put it back in yet. This was like 5-6 years later. He still hadn't put it in yet because he was looking for the right time. I think the markets have appreciated 2 to 3 times since then. So I don't know if he got back in or not, but there are people like that who will do the exact same thing. They'll get out somewhere in the middle or down near the trough of the next market correction or bear market when they happen, and they won't get back in because they'll be waiting for the right time.
You know what that reminds me of? I was watching, it was a nature show, and it was talking about movements of the collective in nature. So like wildebeest going across a river in Africa, or birds that fly in the sky. And there's these one type of bird where there's, I don't know how many, but like a lot of birds. And each individual bird makes a correction and it shifts the whole wave, right? And that's what all I can think about for the market, what you're explaining is like one bird shifts, all the birds shift, everything moves, jives, goes left, goes right, goes up and down. That's like visually what I'm thinking when you're talking about that for the crowd, is it just is like birds moving around, which is actually happens in nature. It's the collective, it's the herd mentality, right?
What you're actually describing, Tim, is what happened with crypto, meme stocks, SPAC bubble. It starts as one, and then it just slowly starts to grow.
Yeah.
And then boom.
Which is, and if everybody's listening, if you want to read a really good book about narratives, narrative economics, Robert Schiller's Narrative Economics is a wonderful book to put together a lens of that kind of ideology, or not even ideology, but more of a framework of how to understand how narratives work within the marketplace, like Nathaniel's mentioning. So Nathaniel, okay, so if it sounds like we may be having this rewriting of potential interest rates because the market's a seer, right? They're looking forward into the future of what's going on, which could be pulling down some of these growthy assets. It could be, say, crypto, growthy stocks within the S3EP 500, for example. So a little bit of a rewriting, a re-rating of said values, and bringing price down. But a lot of people typically, like you just mentioned, the Great Recession, or even COVID, I guess, was a little bit of a pretty aggressive correction for a time being. But when people usually hear that, they usually fall back to 2008, or they fall back to 2000, right? Roughly about the 2001 correction, or bear markets and recessions. And people start worrying about, where is the economy going to go? So could you talk just a little bit about like what this means for the economy? We talked a lot about the market, but we're seeing a 10% correction. So correction, 10% from the highs. And then people start worrying that this is going to start maybe affecting their jobs, maybe affecting overall the United States economy.
So a market correction and a recession are two very different things. A market correction is simply, it could be an indication of a recession. It does not mean it is not a requirement for a recession. So going back to the financial crisis, 0809 time frame, that was there was the catalyst of a great many people overextending themselves, purchasing homes that were beyond their means. They could not afford those homes, but the mortgage
with the narrative that you'll always make money in buying a primary residence. Also, that was thrown in there, which drove some
that
of
was
that.
yes, that was decades in the making, whereby our country has been a principal bedrock within our company to own personal property, to own your own home. This was decades in the making, folks. This wasn't just a period of time where the markets just went apeshit. It was decades of time where this was instilled within our culture to think like this. And then it all crystallized in a period of about 4 to 5, maybe a little bit longer, 6 to 7 years after the dot-com bubble and into the financial crisis. There was that period of time where the mortgage industry was incentivized to write loans, because then they would take those loans, repackage them, they would bundle them up and then resell them for a fee. And then this just kept on going and going. The same package would roll over and over and over, finding different buyers, different sellers. And then eventually we just had this huge bubble based there's some great information out there about it. You have the one bundle of loans, and then you had like 40 different derivatives based upon it. Classic. One can argue that you might be seeing that right now in the index fund phenomenon, in that there's the S&P 500 index. It's a benchmark, right? And then how many different index funds are built upon that, and then how many index funds are then built upon a variation of the S&P 500? There's the value, the S&P 500 value. There's the S&P 500 growth. There's the S&P 500 beta. There's the S&P 500 volatility index. There are so many different variations built upon just one index. I don't know what's going to happen with that, but it's going to be fun to watch, to see what happens. There were a number of events that crystallized into this moment where there was a huge amount of excess within the mortgage and home buying market. And it acted as a catalyst that then proliferated through our economic system, because think about it, your home is typically the largest asset of a person's household. So of course it's going to have an effect on the economy. There's no question. Looking at today, there isn't just that one thing, really. There is no. It can be argued many different ways. I don't think that there's any one thing, but then there's another argument out there, for example, where we're in just one big bubble, where due to having interest rates so low for so long, due to the quantitative easing bond buying program that I've already mentioned, due to central banks around the world having the same policies enacted, that there is just one big bubble in every type of asset. Like we already talked about, the cryptocurrency, this is the meme stock, the SPAC bubble, the stocks, bonds, corporate bonds, high yield bonds, all of these things, gold, paintings, wine, all these alternative types of investments, they're all seeing this huge amount of overvaluation, because there's just so much money in the system, because interest rates have been kept so long, quantitative bond buying, easing bond buying program, all these factors. There is a potential that maybe that's true. Maybe the bubble is that big. And with the Fed making moves to saying, hey, we're probably going to be raising rates this year, I think that there's an attempt to slowly prick that bubble. If in fact there is one, who knows? And to slowly let the air come out. Is that possible? I don't know. because then there's another argument whereby the interest rate that the federal government pays on their debt is super low right now. If that interest rate across all of their debt went up by 1%, I think that the interest cost would double at least. And it would be equivalent to what we spend, what the US spends on their military spending per year. Just one interest rate bump. Don't quote me on that. So there's that argument of saying that the feds don't want interest rates to rise because they need to keep them low, because otherwise we're going to have to start printing printing money in air quotes. It'll likely turn into more bond buying, more quantitative easing, because if they were to actually start printing money, then we're going into even higher inflation. So there's so many different variables at play here that there's just no way of knowing.
You can even throw in the other school of thought that with technology is deflationary pressures, because you could be removing jobs, you can be cutting costs due to efficiencies within other marketplaces, which then creates deflation, not inflation, which then causes issues. Because as Nathaniel said very well, right, as what's also causing interest rates to move is inflation, right? They kind of work in lockstep. So if you have deflationary pressures, then you may not see interest rates go up. You may see them go down, which is a whole different school of thought, which again throws it on a different side. So this is how good economists are.
Or you could see a combination of the two, where you're going to see inflation battling deflation, and then they net each other out, or there's like a slight spread in between, and there's no material effect on us. We don't know, people. And I'll tell you what, the economists don't freaking know anything.
Don't forget about age population either, or population growth.
Oh God, the baby boomers
and productivity, because that's what you're seeing in Japan. And the United States is technically, I think the inflection point for the United States for growth of population, I think is coming up, where we actually might see a declining growth rate and not an inclining growth rate when it comes to birth rates.
I think that we've actually, the number is 2. Yeah, the number is 2.1 for a population to continue to grow. And I think we've already decreased. I think we're less than that already.
Yeah, I know we're close for sure. And then you have productivity, which also creates issues because you don't have the workforce to support the economy. I don't know. Yep. But I think, though, that at the end of the day, like Nathaniel mentioned, to kind of, I think he said it very well in the broad stroke, but to simplify it, a recession or a collapse in the economy is not always, the market's not always an indication of that. It's not necessarily positively correlated all the time. There's a reason why Nathaniel mentioned that it's an indicator. It's not the cause and effect. You can see a re-rating of prices in the stock market and not necessarily see people losing jobs. You could even potentially see a bear market and not see people losing jobs. But you could also see a correction and see a recession within the economy, which means that our GDP starts to slow for a certain amount of time. And then, if it continues to persist, you can get into depression territory, like we saw prior to World War II and into World War II, which is a whole different kind of conversation. But as of now, this market correction doesn't necessarily seem to be an indication of a recession. There is a school of thought out that if the Fed overcorrects and raises rates too quickly, it could cause a recession. And so it is a balancing act, as always. And so it's just something that you have to take into consideration. Right now, the labor markets are very strong. But I think there may be, and Nathaniel, you can correct me if I'm wrong too on this, but there may be a bubble in certain labor markets. I think in the tech sphere, you're seeing, at least from what we've heard across the spectrum, it's an employee's environment. It's really tough to hire people with that type of skill set. But on the exact opposite side, finding service help seems to be very, very difficult because people don't want to work in the service jobs, which is causing wage inflation, which the Federal Reserve has been wanting to see. So it's because I mean, I believe in the last decade we've had stagnation when it comes to wage increases. And
The last few decades, actually, I think the 70s, we
is it
haven't really
always
seen it. It's not a stagnation, but it's like the growth has not been equivalent to the growth in GDP.
Gotcha. So that's where we're also starting to see more of a pickup, which is positive for the overall economy, which is great. But Nathaniel, to kind of like, I guess I have one last question, which would maybe be two questions, is do you feel this correction is healthy? Like, what are your overall thoughts on just prices coming down?
Oh, absolutely. It's definitely healthy. Corrections happen all the time. People just have short memories.
Right? What
I can remember December of 18. I can remember January of 16. They happen all the time, folks. It's healthy.
Yeah. So in the event of a correction, or let's say getting into a bear market territory, so 20% down off of highs, what do you suggest for not to give investment advice, just to be clear, but like in general, how should people frame this? What should they be doing? What should they be thinking about?
They should remain consistent to their original investment strategy. Don't switch lanes just because the getting looks poor. Stay in your lane. That's what I'm basically saying. Stay in your lane. Be consistent. If you were making contributions before the downturn, continue to make said contributions.
Okay. So Nathaniel, we're going to close it out. I'm going to start. I'm going to leave you with the last thought, since you did a great job tonight. And I'm going to have you close this up. My final thoughts. I think I mentioned this on a podcast just recently. Systems are complex. The economy is complex. I was talking to a client today. If we knew what was going to happen, Nathaniel, we'd be so rich. We'd have so much money, and everybody else would too. Like at the end of the day, right? But it's hard to know, and there's a reason why people study it, research it, and dedicate their lives to it, and they still don't know, and they're still wrong, and they can still make mistakes. But I do like what Nathaniel just mentioned on what to do. Stay the course, make contributions, and be aware of your financial situation, because your financial situation is not completely tied to the market. You still have a job. If you don't have a job, trying to find one, right? Having some sort of control. I know that's not the case for everybody in the United States, and there's difficulties for people here in the US, but in general, for the general society, people who are making income, that income stream is extremely powerful. But just being aware of what you can do with it and your expenses is extremely important to be able to kind of better yourself, as well as potentially your household or family. And just make sure, like, again, it's understanding the time frame. In the short run, the market is speculative. In the long run, it's a little bit easier to understand what's going to happen. And so you have to know that you need a time frame to allow all of this variability to work itself out to be able to get you to the end. So thank you, Thani, for sharing your thoughts. I'm gonna have you close us up.
Sure. I'm just gonna try and keep it short and sweet. Just stay in your lane. Be consistent. Don't change the investment strategy just because the wind's blowing the other way.
All right. Well, thank you to all our listeners. We really appreciate your time listening to a few guys talk about things that they love. And we hope, again, that you like, subscribe, and share, because it's just the two of us. Remember, Nathaniel saying at the beginning. And everybody have a wonderful rest of your night. Thank you. Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.